One of the expertise that we have in our firm, one of the three, is tax planning. And tax planning works congruently with your business and your individual tax returns and your individual family when you file your taxes. So now, whenever we're doing tax planning for a small business, we're looking to figure out what would be the best option, what would be the best tax structure for the taxpayer, for the business to be reporting their income, their revenues to the IRS. And then on top of that, how to reduce that tax liability via tax planning features and benefits. So we have the foundational tax planning, which is the basic tax planning. And then we have the advanced tax planning features that go into levels which are fairly sophisticated for those taxpayers that may owe at least or make at least $500,000 to $1 million and even more in annual net revenues from a business perspective. But along the way, the individual side of the house plays a major role because obviously the gains on a company when you get issued a K-1 goes directly to the individual who's going to file their taxes unless you're dealing with a C corp. But that would be for another conversation. But in the traditional sense of a either self-employed person or someone with a sub S or a 1065, which is a partnership, obviously the income is going to flow to the individual taxpayer. So when we're dealing with the individual side of the house and we're dealing with tax planning, there are four major risks that we pay attention to and that we try to mitigate and fix on behalf of the taxpayer. The risk of dying too soon, the risk of living too long, the risk of living with a disability, and then last but not least, the risk of living with eroding factors. So I'll go through each and every one in just a second to give an idea of what the capabilities are when you do proper tax planning for yourself and your family. So with the risk of dying too soon, tomorrow is promised to no one. The first death claim that I handled on behalf of a taxpayer was a family member, and she was 34 years of age, died of cancer. And the oldest I've had is 92 years of age, and then obviously in between many of them. So the issue of dying too soon, you have to be able to protect your business, in case of a premature death, who's going to take over the business, who's going to run the business. Have you trained someone? Do you have a family member that may be able to take over the business because he or she has been working in the business with you? What on the individual side? What if you have a family? You're a family of four. You have a spouse and you have two children. What's going to happen after your demise? Who's going to replace that income for your family so they can maintain their standard of living? And there are many ways of doing that. Obviously, we do a lot of work in that area in our firm because we're a tax planning firm as well. The second one has nothing to do with dying too soon. It has to do with living too long. And a lot of Americans are living a lot longer today than ever before because of medical technology and so forth. So it's important to understand that even when you get to the age of 65 or 70, depending on when you're going to pull the trigger on retirement, it's not only the amount of money that you have been able to accumulate through the accumulation period of your life, but now the most important part is distribution. How long you're going to live? No one truly knows. What if you happen to live into your mid 90s? When you get to retirement, I normally plan for 3 decades of retirement. So we call them the go-go years, the slow-go years, and the no-go years. So 65 to 75 are the go-go years. You're still strong. You're healthy. You may be spending more money than you did while you were working. You're now trying to catch up with life because you're no longer working, 60, 70 hours a week. Once you get into your mid 70s to mid 80s, you go into what I call the slow-go years, where your health may not be as good as it was in the previous decade. So now you're slowing down a little bit. You may still be doing some traveling and so forth, but you're going to be staying closer to home. And then once you hit your mid 80s until your demise, then that's what I call the no-go years, because many a times your health is not apropos. You may be just buying time. Waking up in the morning is a win for you. So those are things that you got to be able to plan for. But by the same token, inflation is eating up at your money. Taxes are eating up on at your money. So that means, are you going to run out of money before you run out of life? Most of the taxpayers that I meet for the first time, most of them, I would say at least 70, 75%, their money's going to run out before they actually die. How do you protect yourself? How do you create guaranteed income for the rest of your life? And that's something that is part of tax planning. The third part, once again, nothing to do with dying too soon or living too long, but because you're living a long, long life, now you have the risk of a disability, which means that the longer you live, the higher the propensity for you to have a disability. Long-term care has become a major issue in the United States, and even more so is the cost of paying for long-term care. So you have to be able to plan for a long life, and also for a life that perhaps the last 5 or 6 years of your life may not be the best type of life that you have experienced. You may be in critical health care. You may be in a nursing home. You may be in home health care. Your expenses, your medication, the cost of medication is getting higher and higher. Someone has to hire, either a family member is going to have to provide for you and care for you, or your family may have to hire someone to do that on your behalf. So that's draining on your current retirement assets to the point that there's a very high probability that you will run out of money before you run out of life. And then the last risk that we manage on the individual side of tax planning is the risk of living with eroding factors. Eroding factors is anything that can erode the value of your money. Taxes, inflation, stock market volatility, interest rate volatility, propensity to consume, financial fees, lawsuits. If you get sued because you were driving down the street and you hit someone and you killed that person and you didn't have enough liability coverage on your automobile insurance. So those are things that you need to pay attention to. So when we congruently work with a client in tax planning, not only do we try to maximize the internal rate of return on the business while reducing the tax liability, but also we want to make certain on the individual side of the house that we're able to protect you and your family from the risk of dying too soon, living too long, living with a disability, or living with the eroding factors that I have mentioned. So if you have any questions, please feel free to reach out. My name is Bert Salazar, and you can call me at area code 888-477-0108, or you can send me an email at Bert, B-E-R-T, at GablesTaxGroup.com, and I'll be more than happy to schedule a 20 to 30-minute call with you to discuss your business and personal situation. So have a good day, and we'll talk soon. Thank you, and see you in the next few videos I will be posting to all of you.